Welcome once again to the 365 Retirement Podcast with the team at Rubino & Lang Wealth Partners. My name is Randy Cook. I'm here with Ryan Marston of Rubino & Lang Wealth Partners, talking through some of the issues that you might be wondering about, thinking about, worried about, the things that happen after you hang up your cleats. You're done at work, you're done in the cubicle, you're done with your hard hat. That's it. Now all the money that you've saved all these years is going to power your retirement. How does that work? That's why we're here. Ryan, how are you doing today?
I'm doing great, Randy. I'm excited about this, topic, and I can't talk about this enough with clients. Right? The different taxation of money and how it works, and how important it is to have different buckets.
Yeah, absolutely. So we're going to talk about what probably is the biggest bucket of money that most people walk through your door with, and that's their 401k. I was a part of that in 1978. I just started my working years, and I looked around, and there were people who had pensions. I thought, what a great thing that at the end of your working career, you just keep getting paid. But I don't have that. So they offered me this thing called a 401k, and they said, here's the great thing about it. You get to say where your money goes. You get to put the amount of money in there, and it grows, and when you retire, it'll all be there for you. Well, it seemed like a great idea at the time, so here I am now, 63 years old, not far from using that money, and there's a couple of things about it that didn't turn out the way they told us. One of them is the taxes. Oh, my gosh. You're putting all this money away, and it's tax deferred, so you have to pay the taxes on it when you use the money. So, Ryan, is there a point where you look at somebody and they walk through the door and you look at them and they're, say, 62 years old, they got a few years left, and you go, you've probably put enough money in this 401k. Let's look elsewhere. Does the 401k kind of have a certain shelf life for you as a person getting ready for retirement?
Yeah, that is a common conversation I have. With clients and prospects.
Okay.
More often than not, I would say someone would come in and sit down with us, and they might have some money in checking, savings account, maybe a little bit in a CD or something like that. And then all their retirement assets are all in tax-deferred accounts, meaning IRAs, 401ks, 403bs, but all pre-tax assets. Nothing in tax-free assets, Roth or anything of that nature, Roth 401k. So when we look at things, we look at what opportunities we have ahead of us, not just what we've done in the past, right? The past is the past, and we just want to try to improve our situation or our clients' situations as much as possible moving forward, getting them ready for the retirement years, whenever it might be. So a lot of the times we'll look at it and say, hey, Joe and Suzanne, we have a lot of assets already saved up in your 401k or IRAs and pre-tax assets, and they might be getting a match from their employer. Well, let's start shifting some of that percentage of a contribution that you have inside the 401k into the Roth side of your 401k, which a lot of times they don't even know is available. The employer's match will still go into the pre-tax side, but now your contributions might be going into the Roth side, which has a huge benefit when you retire. Not only does it grow tax-free, but it comes to you tax-free. You don't have to worry about the piece that the IRS is going to get, like they would with all your tax-deferred assets when you make withdrawals. So that conversation happens a lot. You're going to want to take a look at how making a shift like that in your contribution rates is going to affect your current taxes, project out future taxes, which is very hard to do because nobody knows what the taxes are going to look like in 2026 as of right now, right? There's a lot up for debate. So, we just want to see how things will be affected by making any changes like that, and gradually go forward with them.
Well, there's two things about the 401k that are lacking. Number one, it doesn't generate a paycheck like a pension does, so we'll talk about that. But the other thing is we refer to it as a tax time bomb. If you keep putting money in there, at age 73, you got to start taking that money out. Now, that might not seem like a bad thing. You got to pay the taxes as you get the money out, but if you have $1 million 401k or $1.5 million or even $2 million in a 401k, you got to take a pretty big chunk out every year, and that money could affect your Medicare premium. It could affect the taxation on your Social Security. It could bump you into another tax bracket. So having all that money and saving it and waiting till 73 to take it sometimes is not the best strategy, is it?
Absolutely not. So again, like you said, if you have $2 million in a 401k and all of a sudden you retire, or you're retired and you hit age 73 and you haven't taken any withdrawals, maybe because you didn't need it. Maybe you have a pension, maybe you have other sources of income, but that quote unquote retirement tax bomb has been sitting there growing, and it's at $2 million now. Well, ballpark. It's just under, but about 4% of withdrawal rate at age 73 that the IRS is going to mandate you take and pay taxes on. Well, that is $80,000 that all of a sudden is going to be added to your income along with whatever other sources you have, and it might jump you significantly in your tax bracket, which has a trickle-down effect like you mentioned. Medicare, IRMA, how you might be paying premium surcharges over the course of the next few years or longer because of the RMD that's now coming out, that will add up. Social Security, you get taxed on Social Security at your highest marginal bracket. So you might jump brackets because of this RMD, and all of a sudden your Social Security is going to get taxed at a much higher rate and more of it. So there's a lot of effects that it has at, the RMD age specifically if you just kick the can down the road. Never mind growth on top of it, and it could be a much higher number. But Uncle Sam has a piece of it. It's never too late to look at what options you have ahead of it. You could be in your mid or even late 60s. But the more time you have, the better. And if you can start looking at Roth conversions gradually over the course of years and spread them out, reduce the amount you have in an IRA, pay taxes on your own accord within the brackets yearly, let's say for 5 to 10 years, move money into the Roth IRA. Well, your RMD is going to be a lot smaller than it would have been because your IRA balance is a lot smaller. The IRS doesn't make you take out money at age 73 on your Roth IRA because they don't get taxes from it. So they don't care what you do with it. So if we can shift assets gradually, pay smaller amounts of taxes yearly as opposed to a much larger tax, for a bigger potential portion of your retirement years, it makes a lot of sense to kind of look at strategies like that. And, the fourth quarter is when we really start to look at what your situation is for the year, what your tax situation looks like, and if Roth conversions might have advantages within your specific situations.
I presented that idea to my wife because I'm kind of in that situation right now. And she is like, every April, we have to write a huge check to the IRS. Why would I want to write a bigger check to the IRS? And so I said, well, let me explain it to you in a way that you can understand. Say, for instance, you charge $10,000 on your credit card. She can relate to that. And what do you do when you get the bill? You get the bill and you have to pay $100 a month. Well, it's going to take you forever to pay off that money at $100 a month. So you pay $500 a month. That way you pay it off sooner and you save yourself interest. Same thing with taxes. Pay a little bit off now, and it'll save you money later, especially in taxes. So when you look at it that way, it kind of makes some sense.
Yeah, it does. I mean, if you can, I'm just going to make up numbers here and use an example, but if you could pay taxes of, effective tax rate of 20% today in chunks, and let's say it's for the next 10 years versus 10 years out, pay 30+%, 32% effective tax rate on any withdrawals. Well, that's a pretty big savings, and not to mention everything you're moving into the Roth IRA today will now grow tax-free forward versus if you didn't make that decision, it's growing tax-deferred still, and you're increasing that tax time bomb, for come age 73. So it's got a lot of benefits to it if you can see through them. The one thing we don't know, again, like we always say, is the tax. We know what the tax code is slated to be as of right now for 2026 beyond, but the realistic chances of it being that are slim. So we know what we have to play with today. We're in a really low tax environment today, and if you can take this opportunity and it makes sense for your specific situation, you should really consider moving forward with something like that with your advisor. You get 2 years before those expire.
Do you encourage people to go into retirement with all three kinds of money, tax-deferred money, tax-free money, and so a little bit? So maybe you would have your 401k, and if it was $1 million, you wouldn't convert all of it, or do you want to get to 73 and have it all converted over? How do you view that?
Ideally, you want all tax-free money, right?
Okay.
But no, it doesn't make sense for a lot of people.
Okay.
The realistic situation is we try to get as much out as possible. You don't want to all of a sudden skyrocket into the maximum tax bracket today just to make Roth conversions. Some situations it will make sense, and I do that with a handful of clients. But a lot of the times you want to gradually make contributions, and it's just not realistic. You're going to get everything out of your tax deferred money. But we can manage it down to a level that we know what your RMD will be, and it might not have as dramatic of an effect on your IRMA for Medicare or your Social Security. So if we can get that down to a level, let's say you have $1 million in a 401k, and we can get 500 out by the time you're 73. Well, you have 500 in the 401k tax deferred, and maybe 500 in a Roth. Now, so that split will reduce your RMD by half. It gets a good amount in this tax-free bucket now. So everyone's situation is very different, and looking at it, it's not always very realistic that you can get everything out of tax-deferred assets, because like I said, most people we see come in with a majority of their assets in the tax-deferred bucket.
The other place where that 401k comes up lacking is it doesn't generate a paycheck like the pension does. It doesn't come out that way. So we have to figure that out. That is up to us to figure out is, peeling money off the top. And it might look good as $1 million 401k, but know this, every time you take money out, you got to pay the toll. You got to pay the pet taxes every time you take money out. So if you needed $1,000, you may have to take $1,200 in order to do that. Yep. So what do we do about income? Here's my biggest block of money, Ryan. How do I make it a paycheck?
Yeah, so some people will have pensions or other sources of income, but I'd say it's the rare bunch, right? More often than not, people when they retire have a bucket of assets and Social Security, right? And Social Security for most people isn't enough to cover expenses. They need more income. So if you have all your assets in a 401k, you're very limited on what your options are, right? And within your 401k. So to look at different sources of income, maybe through the use of an annuity that will give you a guaranteed income stream because you're not fortunate enough to have the pension, which would be a guaranteed income stream. You'd have to move it out of the 401k in order to pursue those options and try to get your guaranteed income or your income to a level of where it's close to what your expenses are in your net income, right? We want to look at what your net income is because that's what truly matters when you're looking at your expenses. If you spend $80,000 a year, well, it'd be great if we could get your net income close to that $80,000 a year number. Leave some assets for growth on the sideline that can keep up with inflation and things like that. And that is, the benefit of moving assets outside the 401k because you just, as good as they are, as cost effective as 401ks are and the investment options within them, they're still very limited usually in what the options are. So you have to move money assets out into a rollover IRA, very simple to do. And then the world is your oyster in terms of the investment world and insurance world. You can do whatever you want with it once it's outside of it. So a lot of the times it will make a lot of sense once people retire or it's in certain circumstances while they're, at the end of their working years that they pursue options like that.
Well, think about it this way. For most of us, our 401k is going to be our biggest retirement asset. Years ago, when our parents were retiring, their house was their biggest retirement asset. They would sell their house, they would downsize, they would use that money for retirement. Now, we're putting, $1 million, $1.5 million over our 30-year career into 401ks, and it's all tax infested. How do we deal with that? And it's an important conversation. Many of us are in that boat. Give Ryan a call. Give the team at Rubino and Lang Wealth Partners a look, and let's talk about your 401k and how, number one, to make it into a paycheck, and number two, how do we detax that thing so that you're not at the highest tax level? give us a look on our website, which is 365retirement.com. 365retirement.com. Up in the right-hand corner, you'll see a button that says Talk to an Advisor. Click on that. You'll be on your way. You can even schedule your meeting. And that meeting is just kind of an introductory meeting, 15 minutes. And we're going to kind of feel each other out, find out what's going on in your life. What questions do you have? How can we help? And I mean, Ryan, if somebody looks at you and during that meeting and says, hey, Ryan, everything I've got is in a 401k. How do I deal with this? I mean, that's really what we've been talking about today, isn't it?
I mean, as much as you don't want that, for the person, that's, it's not
common.
It's music to my ears, though, because it allows me to do what I do best, right?
Gotcha.
Go to work for the client and design a plan or a strategy that can put them in a better situation 5 years from now than they are today, right? And it's never too early to kind of, or too late for that matter, to take the step and reach out to someone for help to see if you can improve your current situation. Every year matters, but you're never, so limited that it's too late. Every year counts, so.
Well, we would love to have the opportunity to meet you, talk through what your concerns are. You can start by going to our website, 365retirement.com. Click on that button that says Talk to an Advisor. We thank you so much for watching, and we hope you'll join us again next time here on the 365 Retirement Podcast.